How to Value Companies by Aswath Damodaran. I came across this man maybe a month or two ago, and I was just, looking at some YouTube videos, some podcasts, trying to learn more, and I came across him. He's a professor of finance at the Stern School of Business at NYU. Very smart individual. I love how he thinks about investing, long-term investing, how to value companies. It's simple. He shares all his info online. He, told the universities flat out, if you want me to do this, you have to be able to let me put this for free online. So you can get all his information, all his courses at NYU, a full NYU course on valuation on his website. So if you're serious about investing, this guy, he's one of them ones, and I hope and I aspire to be somewhat like him one day. Not like exactly like him, but continue sharing information, continue helping investors, help their financial journey. And what I have gotten from him, and what's interesting about him, he's so old school in a lot of retrospects. His students might show him like the tweets about value investors and how they're blindly fans of Warren Buffett, Charlie Munger, and so he likes to take jabs at value investors sometimes and say they're not as good as they say they are. But he also intimates that he has nothing against Warren or Charlie Munger. It's just that their philosophies have turned into a cult, and a lot of their people that follow them can become less flexible. And he's very against that, and I'm okay with that too. I believe I'm a value investor with growth tendencies, so I'm very flexible, and so I fall more in his line. So how he values companies is pretty simple. It's future cash flows, growth opportunities, with the risk, minus the risk. So that's the company valuation. So you look at their future cash flows, you see their growth opportunities, and you try to calculate what the real risk is to them in the future. And he also talks about, the stock's story. What's the stock story? Is the story adding up to what's playing out on the paper? And that's why I was talking about with LTNC earlier. The story has to match up the numbers on the paper as well. What leadership casts out to shareholders in the world via PRs and social media interviews and such, it has to match on the paper as well. What's the stock story, and is the story going out properly? So that's very important. And he talks about the discount rate as well. I'm still learning a lot about the discount rate. It's still kind of confusing to me, but it's something I'm working on from it. The discount rate is the minimum rate of return expected to be earned on an investment given its risk profile. The present value of future cash flows generated by a company is estimated by using an appropriate discount rate, i.e. opportunity cost of capital, which reflects the riskiness of the underlying company or investment. So the discount rate percentage, future value to the nth power divided by present value minus 1. And so it's something I still need to work on personally myself. It's still kind of confusing, but I've learned a lot from him. And here's some gematria to back it up. So we see, I took all the words that he likes to use: stories, discounts, evaluating, a company, cash flow. And you see all the 33. So look, stories, discount, evaluating, company, cash flow. All 33 English ordinal. That's our number right there, no? Right? That's our number. That's what we want to see. But on top of that, look, stories, discount, 105 English ordinal, 33 reduction, 48 reverse reduction. So 3 of the 4. Then we have a valuing, company, cash flow. So you see, look, a valuing company, cash flow, 87 ordinal, 33 reduction, 129 reverse ordinal when you discount the company. So all these words are very similar, and it goes back to the financial keywords that Aswath likes using a lot. So it's something I'm still working on, but with the knowledge I've gained from Aswath, I'm able to take it further already. So the company valuation, that's how I'm valuing companies now. I'm looking at their future cash, what I believe their future cash flow is, what's their growth opportunities. So if they have growth opportunities, how can those future cash flows get in there? So how can we get those growth opportunities to be monetized? And what's the risk behind it, right? If I believe a company is worth 2 billion, so what's the risk of it not getting there? Where would it land if it didn't reach its potential with all the growth opportunities and future cash flow? So that's stuff I like to take in mind. So that's a quick slide on how to value companies. Aswath Damodaran, somebody you really need to look up. I'm dead serious. You need to look him up. You know, some of the best content I've ever heard on the stock market and valuation comes through him. Seriously.